Stock dilution. Explained. This can be common with a lot of these small cap junk companies. What are diluted shares? And why should you care? A company's shares become diluted when it introduces new shares to the market. Dilution can happen through a stock offering, or it can happen through the conversion of warrants, stock options, or convertible notes. Dilution increases the number of shares outstanding. The main reason a company would dilute its shares is to raise money. That's why you see it so often in small cap stocks, because they tend to be sketchy companies operating on little to no budget. They are small, developmental companies. Some might not even have a product on the market. If there's no product or sales, there's no income. A lot of these companies are usually desperate for cash. They need money to pay bills, make debt payments, pay employees, or further develop their product or technology. So how do shares get diluted? A company can dilute shares if its board of directors approves. But there are steps the company has to take before it can create new shares. It has to file the appropriate paperwork with the U.S. Securities and Exchange Commission (SEC). Then it has to disclose the new stock offering to the existing shareholders. This is usually done through a press release. Once the directors approve the issuance of new shares, the company can sell more shares into the market or obtain financing in exchange for shares. More on toxic financing in a future video. Companies can also increase shares outstanding in other ways. Stock splits and stock dividends are also ways of creating new stock. Instead of selling the new shares to the market, the company parcels them out to existing shareholders. This doesn't dilute stock ownership, but it still results in a diluted share price. These moves don't generate any new capital for the company. They are looking to attract new investors with a lower stock price. We saw this with the recent Tesla and Apple stock splits. Forward splits and dividends are considered positives because they give value to existing investors. Share dilution is legal as long as the company files the correct disclosures. But that doesn't mean it isn't shady. Small cap stocks run in a cycle of stock dilution and reverse splits. A company will announce some promising news, get its share price up, then do an offering of more shares. Eventually, the price goes back down and traders forget about the stock. Then the company will do a reverse split, which reduces the stock float and increases the share price. Then they start the cycle all over again. This is an example of the SEC S3 form. This is PHUN stock and the date is February 1, 2022. In the SEC S3 form you can read the offering details, and as you can see in this offering is for $200 million is worth of common stock, preferred stock, and warrants units. Investing in any securities involves a high degree of risk. You should carefully read and consider these risk factors before you invest in any securities. What happens when shares get diluted? When the number of shares for the company increases, the value of each share goes down, and so did the earnings per share. This can cause a lot of investors to sell their positions. Larger companies can dilute their shares, as well. But with larger companies, it doesn't happen as often and can signal big trouble. What are undiluted shares? When investors talk about undiluted shares, they're talking about undiluted earnings per share. It's a way of calculating earnings per share without accounting for possible future dilution from convertible notes, warrants, or restricted shares. With this calculation, you get the best case scenario for earnings per share, and it can make a company look better than it is. Especially if it has anything outstanding that can be converted into common stock in the future. Basic versus diluted shares, what's the difference? Calculating fully diluted shares gives you the worst-case scenario for a stock's earnings per share. Diluted earnings per share include any convertible notes, stock options, and warrants, and anything convertible into common stock. But basic shares are the outstanding shares held by shareholders at calculation, not accounting for possible future dilution. Similar to the undiluted share calculation. This will give you a completely different picture of how the company is doing, compared to calculating the fully diluted earnings per share price. Let's cover some basic warning signs that might mean a company is about to issue more stock. Debt. Most companies have debt, small cap stock companies especially. That's not always a bad thing, but when a company has more debt than income, that can create a problem. If there's not enough money to go around for regular operating expenses, plus debt payments, then the company needs to generate cash. If they don't have a way to increase sales or reduce other expenses, they often look at selling more shares. Company growth. With small cap stocks, as soon as there is a huge increase in the stock price, dilution is always possible. A big jump in a stock price could be because someone's pumping and promoting the stock. A company might promote its stock ahead of an offering, or they might have outstanding warrants or convertible notes to dump on retail investors. When you see a stock up 30% or more in the pre-market, check the SEC filings for possible dilution. It's part of your due diligence. Diluted earnings per share (EPS) with large cap stocks and conventional investing. Earnings per share is a common way that investors calculate the value of a company's shares. Raise its earnings per share, it increases the value of the company and the share price. But the number of shares outstanding affects the calculation. If the number of shares increases, the earnings per share, or size of your slice of the pie, goes down. Calculating diluted earnings per share takes all outstanding shares, plus any warrants, convertible notes, or stock options that can be converted into common stock. How does share dilution affect share price? Share dilution almost always results in a drop in the share price. There are a few reasons for that. Short sellers. If there's bad news released, short sellers are there to ride the stock price down. Supply and demand. Dilution creates more supply. It takes a lot more volume, or demand, to move a higher float stock's price up. Change in value. Current investors sell out because the shares aren't worth as much as they were before they were diluted. Combine all those factors and you get lower share prices. To make things worse, an offering is usually at a price lower than the market value of the stock. That means all the people who bought above the offering price just overpaid. Even if the offering is done at the market price, the price will still usually go down. How to calculate diluted earnings per share. The diluted earnings per share (EPS) calculation looks like this. Diluted EPS equals net income preferred stock dividends average outstanding shares dilutive shares. If a company has dilution, the diluted EPS calculation will equal less per share than a basic EPS calculation. How can you use diluted EPS to analyze a business? Diluted earnings per share can give investors an idea of what the price per share should be if all possible outstanding shares hit the market. It's like knowing the worst-case scenario of your investment. If a stock is trading too high, you can wait for a dip to enter. Anything that can give you an edge in the market can help your trading or investing. Is dilution good or bad for stocks? With small-cap stocks, dilution is definitely bad for the price of the stock. You'll likely see a huge sell-off and a decline in prices. But with large-cap stocks, investors have a bit more trust in the company. They could look at secondary offerings as a good thing in the long run. The company can raise more money and restructure itself without taking on any more debt. But some investors will look at it as a loss of value. It all depends on investor sentiment and their perspective of what's considered good or bad. The diluted shares conclusion. Diluted shares can signal trouble in penny stock land. Be cautious if a company announces offerings, warrants, or convertible notes, or if insiders are selling. Dilution usually causes a steep drop in share prices, and short sellers can add to the selling pressure. Always expect the worst out of every stock. They generally don't care about shareholders. They care more about raising money to continue their pump schemes.